In this video series, we review accounting for a lease. Did I say fleece? We'll start leases with some basic concepts, then we'll jump right in and categorize leases for the lessee. And we'll do a problem to see these concepts in action. Let's get started. What is a lease? A lease is when you pay rent to use something. Like when you lease an apartment, you pay rent to use the apartment. The apartment isn't yours to keep, but the payments give you the right to use the apartment. There are two basic lease parties. The lessee pays rent to use the asset, and the lessor owns the asset and gives a right of use. The complexities arise when a lease, which is supposed to be a rental, is really a purchase with a loan. When we categorize leases, ultimately, that's what we're trying to figure out. Is it really a rental or a purchase with a loan? To figure that out, let's start with the lessee, the renter. Just remember, the lessee is full of shit. F, finance. Does it hit any of the 5 criteria? We'll go over the 5 criteria in a second. Hold that thought. If it meets any of the 5 criteria, then it's a finance lease. If it misses all 5, then it's O, operating. Except there's always an exception. If the lease term is 12 months or less, and there is no reasonably certain purchase option, then it's S, short term. Just remember, the lessee is full of shit. F, finance, O, operating, and S, short term. We'll start by focusing on F, finance. Here's the 5 criteria. Criteria 1. Is there an ownership transfer? Meaning, does title to the asset transfer to the lessee, the renter? Criteria 2. Is there a purchase option that is reasonably certain to be exercised? A purchase option is just that, an option to purchase the leased asset. Here's where the reasonably certain comes in. There has to be an economic incentive for the lessee to take the purchase option. Like if the purchase option is a big discount from the asset's value, or if you made a big investment to make custom changes to the asset. In both cases, it makes sense from a money perspective to take the purchase option. Then it's reasonably certain the lessee will take the purchase option. Criteria 3. Is the lease term 75% or more of the asset's life? Criteria 4. Is the present value of the lease payments 90% or more of the asset's fair value? And criteria 5. Is the leased asset so super specialized that it has no alternative use? Meaning no one but the lessee can use it. Let's take a step back and look at these 5 criteria. There's a theme. Each of these points to the lease being a purchase rather than a rental. Criteria 1. Ownership transfer. Ownership generally transfers when the lessee buys the asset. Criteria 2. A reasonably certain purchase option. That means we assume the lessee will take the purchase option. The lessee will pay the purchase option price to purchase the asset. Criteria 3. Lease term 75% or more of the asset's life. It's being leased for a major part of the asset's life. The lessee is getting almost all of the asset's use. Criteria 4. The present value of the lease payments is 90% or more of the asset's fair value. You're basically paying for the asset, 90%. And criteria 5. The asset is so super specialized that no one else can use it. Then it was essentially made for that one lessee. The lessee is going to have to pay for that. It's really a purchase, not a rental. So you see, if you hit any one of the 5 criteria and you only need one, then it's a finance lease, which means it's really a purchase, not a rental. And just like any other purchase, the lessee records an asset. Debit right of use asset, because that's what a lease is. Payment for the right to use the asset. What's the other side of the entry? The leased asset is paid in installments through lease payments, which are really loan payments. So the lessee is purchasing the asset with a loan. Here it's called lease liability. Let's see how this all works with an example. The prompt reads, on January 1, lessee leases a machine from lessor for 3 years. This tells us it's a lease question. An important part of the exam is organizing the information that they give you and anticipating where the question is going. Here, let's organize the lease provisions. We just read that the lease term is 3 years. Back to the prompt. The lease terms include annual payments of $100,000 starting at commencement, and then to be made on December 31st before each year of use. The present value of the annual payments is $283,339. The machine's fair value is $300,000, and its useful life is 4 years. Lessee depreciates using the straight line method. Lessee knows the implicit rate of the lease is 6%. Provide lessee's journal entries at January 1Y1. That was a lot. Don't be intimidated by the sheer number of words. Just break it down sentence by sentence. The question asks for lessee's journal entries. Let's figure out what that means. The prompt says lessee leases the machine from lessor. That means lessor originally had the machine. Lessor is the owner. Then lessee is the renter, the one who pays to use the machine. Next, what type of lease is this? That will dictate the journal entries. Remember, the lessee is full of F, finance, O, operating, and S, short term. Starting with F, finance. If we hit any one of the 5 criteria, then it's a finance lease. Criteria 1, ownership transfer. Criteria 2, reasonably certain purchase option. Criteria 3, lease term 75% or more of the asset's life. Criteria 4, present value of the lease payments is 90% or more of the asset's fair value. And criteria 5, the asset is so super special that it has no alternative use. The prompt doesn't say anything about ownership transfer, purchase option, or no alternative use. So criteria 1, 2, and 5 are out. That leaves criteria 3 and 4. Under criteria 3, the lease term is 3 years divided by the useful life of 4 years equals 75%. We hit criteria 3. And under criteria 4, the present value of the payments, $283,339, divided by the fair value of $300,000 equals 94%. We also hit criteria 4. We only need one of the 5 criteria. Here we have 2. This is definitely a finance lease, which means it looks like a rental, but it's really a purchase with a loan. Let's do the journal entries. Lessee entered a lease agreement. On 1/1/Y1 commencement, lessee is obligated to make lease payments. How do we record an obligation to pay? That's the definition of a liability. Here it's called lease liability. This lease is for 3 years, then it's a non-current liability. And just like other non-current liabilities, it gets recorded at present value. Here they give us present value, $283,339. This is the lease liability, what lessee still has to pay on the lease. And it's non-current, so you discount it to present value. So the lease liability is just the present value of the lease payments that lessee still has to pay. Liability increasing, that's a credit. What's the other side of the entry? The asset. Remember, this is a finance lease. They're calling it a rental, but it's really a purchase, so record it like a purchase. Lessee puts the asset on its books. Asset increasing, that's a debit. But this isn't an outright purchase. It still looks like a lease, even though we really know it's a purchase. So rather than debiting the asset outright, we call it a right of use asset, because that's what a lease is, paying for the right to use the leased asset. Note, the right of use asset has multiple components. The primary component is a lease liability. We'll look at the other components in later problems. Here, it's just the lease liability, $283,339. That's the entry at commencement. In this problem, we have another entry at 1/1/Y1 for the first payment. The prompt says annual payments of $100,000 starting at commencement. Lessee makes a payment of $100,000. When you make a payment, you spend money. That's cash going down, credit. What's the other side of the entry? Typically, we allocate part of the payment to interest expense. Then the rest reduces the lease liability, the loan principal. But interest only occurs with the passage of time. At commencement, no time has passed. Then there is no interest expense. The entire $100,000 goes to lease liability. Let's compare these entries to a straight purchase. If lessee purchased the asset outright, what would the entry look like? Purchaser would record the purchased asset. Asset increasing, that's a debit. And purchaser would record a liability for the loan used to pay for the asset. Note payable, that's a liability, increasing, credit. And if the purchaser made a payment at the time of purchase, just like in the lease problem, that's cash, decreasing, credit. What's the other side of the entry? Typically, when you make a loan payment, part is allocated to interest and the rest goes to the loan principal. But interest only occurs with the passage of time. At the start of the loan, no time has passed, so there is no interest expense. Then the whole loan payment goes to note payable, the loan principal. Let's compare these entries side by side. At the time of lease commencement and purchase, the entries are basically the same. We debit an asset and credit a liability for the loan amount. At the first payment under both transactions, we debit the liability and reduce the loan principal and credit cash. Looking at these entries, we can see that a finance lease is just a variation of a purchase with a loan. Just to summarize, the lessee is the renter who pays to use the asset. And remember, the lessee is full of shit. F, finance. If you hit any of the 5 criteria, then it's a finance lease. If it misses all 5 criteria, then it's O, operating. Except there's always an exception. If the lease term is 12 months or less and there is no reasonably certain purchase option, then it's S, short term. And remember, a finance lease looks like a rental, but it's really a purchase with a loan. Next up, we'll review how the lessee accounts for lease accruals. You want to be sure to hit these points on the exam, so don't go away. I'm Liz Cho with Test Prep in a Snap.